Hi, everybody. Jen Berbas with the Berbas Group in Austin. I want to talk to you a little bit about the November real estate numbers and our December newsletter that's going out. I want to try something just a little bit different than what I usually do. I want to talk about some of the economic metrics, if you will, that everybody's talking about and as they relate to real estate. So, a lot of people think that the Fed actually sets mortgage rates. It's a little bit more derivative than that. The mortgage rates are set, they're correlated to the 10-year Treasury. The ticker that I watch for this is TNX, but they're basically correlated to 10-year Treasury. Mortgage rates are usually like 130 basis points or 170 basis points above where the 10-year Treasury is. So everybody watches the Treasury. While the Treasury traders that set the Treasury pricing watches the Fed. So indirectly, the Fed does set the Treasury, does set the mortgage rates. But I thought this was kind of interesting. This is a Fed Watch tool that the Chicago Mercantile Exchange has. There is going to be a meeting this coming Wednesday, and there is a 96% chance, according to the traders, this is basically a poll of the traders, the way I understand it, that the Fed rate will be lowered to 4.25, 4.5. What I think is interesting is you can also look further out. Now, obviously, the further out this goes, the less confidence people have in it. And you can see that because the distribution is wider. With something that's, the Fed meeting's coming out this week, there's a lot more consensus around it, but a lot can happen between now and March. So if you look at the March numbers, you can see they're a little bit more spread out. The March numbers are also 4 to 4.25. So the traders think that by March, the rates should be a little bit lower, and they are expecting them to be a little bit higher than that March number this coming Wednesday. So that's my deviation from our normal scheduled programming. But one of the things I wanted to point out is some economic numbers came out this last week, and so that were inflationary for the most part. There's one that's not inflationary, and that kept interest rates high. It kept bonds low. When bonds go down, interest rates go up, and the reason for that is it looked like that they are inflationary. I have some notes here. CPI, which is Consumer Price Index, came out right at expectation. PPI came out above expectation. Now, jobless claims were up, and normally this would not be inflationary. It would contradict an inflationary environment, but that wasn't enough to keep interest rates from going up this last week, just a little bit. And even though we anticipate Fed lowering, that's already baked into the market. So if that happens, don't really expect mortgage rates to come down. I think it's kind of fun. Obviously, if anybody that knows me knows I used to be a trader, and so I like the economic portion of this. Now let's go into the numbers. I'm going to share my screen there in a second. We are seeing a little bit of better news in the Austin real estate market. Total sales are up 8.6%. From this time last year. So what we've been talking about with our clients is I actually think this is better news than it would indicate. Like 10% is great, but also we're coming off the highest inventory numbers that we've had in 13 years. So 2024 real estate inventory numbers, the options for buyers to buy, were higher than it's been for 13 years. Even in light of that, we have 10% more home selling. I think that's great. Also, we're seeing some of our regular seasonality, right? Things kind of slow down this time of year, but year over year is what I would watch at this time of year. And I think it's really interesting. So good news from the demand side of the Austin real estate market. This is the average sold price. Normal seasonality patterns here, nothing too exciting, kind of what we would expect. And to us, it feels like, we never know if we're right, but it feels like the pricing is like bouncing around the bottom, bouncing along the bottom, hopefully waiting to recover a little bit. Sales are up 8%, like we said, 8.7% from last year, which is really exciting for us. And then the average sold volume is up around 12%. This is the data that we watch internally on our team. We collect this within 12 miles of downtown. And the reason for that is this is where the bulk of the basically transactions happen in the Austin MSA. And so if we watch this, we can kind of get a pulse for which way the market's going. This time of year, the way we're using this chart is number one, we're back down to the inventory levels from this time last year, which I thought was very interesting. We're around 1,600 from the available properties the top line is active properties. The second line is properties going under contract for the last 30 days. Then the dark blue line is properties that went under contract last week. Okay. So this time of year, we're starting to look at the inventory. We're watching it go down. We expect it to go down further in about 2 weeks. We expect to see another drop, kind of like this that we saw last year, right? Where in that 1 week or two, about 20% of the housing inventory came off the market, and we're expecting to see something like that. Then what we're waiting for is we want to watch when the buyers start coming back into the market. Right here, the orange line starts pushing up, and when the inventory has not yet started picking up. We like to list homes right around here. We think that provides like a really good moment when the buyers feel a little bit of anxiety. I don't know if they even realize why, but we think it's interesting and a great time to list. Pending units by month. This basically reflects what we had been talking about, right? We're seeing 10% more pending units this last month than we saw this time last year. That's good. So what you need to keep in mind with this is a decrease in job postings on Indeed. And so it seems like our acceleration to the downside is stopping, right? It's getting a little bit better. You can see here the chart. It's not great yet, but also this is not a normal time of the year for there to be a ton of hiring. Most people that I'm talking to that are looking for jobs are expecting something in Q1, Q2 of next year for hiring to pick up. So given the seasonality, this is not terrible. And it's getting just a tiny bit better than it has been over the last year or two. Let us know if you have any questions. We're always around to just strategize or just talk about your real estate portfolio. Feel free to give us a call. I'm happy to set up some time to do that with you.